Is there a bubble building up in the world of artificial intelligence? Yes, absolutely there is. Is it going to burst anytime soon? No, it won't. I know what I am saying is the exact opposite of what the experts, the economists, the financial gurus have been saying now for the past few weeks or so. They are looking at the valuations, the investment loops, and they're telling you that these are red flags to watch out for. I believe they're fundamentally and completely wrong. I'm being what some would call a devil's advocate here, and in this video I will explain why the mainstream view about the AI bubble is completely misguided. But to understand why this bubble is different, why it won't pop like the others in the past, we need to take a little detour. We need to look at how our capitalist economy actually works. Not the way you're taught in economics textbooks, by the way, with the neat little graphs of supply and demand, nor what you learn from the media or absorb from popular culture, but the real inner workings of capitalism and the power structures that truly drive it. But before I get into it, I have one small request. Please take out 2 seconds and subscribe to this channel. Right now, more than 80% of you who are watching this video aren't subscribed. If you like content that challenges the mainstream narrative, that goes beyond the headlines, subscribing is the single best way to support what I do. Okay, back to our story. To understand the AI bubble, you first have to unlearn what you think you know about capitalism. All capitalist economies are divided into two broad groups of people. On one side are the entrepreneurs, the capitalists, the people who own the companies, the factories, the offices, the code repositories. On the other side are professionals and workers. Everyone from a software engineer to a gig worker, a CEO to a janitor. Entrepreneurs buy the labor power of workers, including high-priced white-collar professionals, and they pay them salaries and wages. Workers in turn use their skills, their time, their energy. They work on the machines and computers to produce goods and services. These goods and services are then sold by the entrepreneurs in the market to recover their costs, and what else? Yes, of course, to make a profit, right? That at first glance seems to be the driving force of any capitalist enterprise, maximizing profits. This is the first and biggest mistake everyone makes. The real aim of every true entrepreneur is not just to make a profit, it is to accumulate wealth. It is to constantly expand and increase the amount of capital they have by reinvesting their profits. Profit is just the means to an end. Accumulation is the goal. This is a fundamental feature of capitalist wealth, and it's what makes it completely different from wealth in pre-capitalist societies. Now think about it. The kings, the landlords, the zamindars, they used to accumulate wealth. Why? To spend it, to consume it, to build palaces, throw lavish feasts, and even go to war. They stored their wealth in unproductive assets like mountains of gold and jewels. Wealthy entrepreneurs, the modern day capitalists, are a completely different breed. They often have relatively simple lifestyles, at least when you compare it to the sheer scale of their wealth. Yes, they buy yachts and private jets, but that spending is just a rounding off error on their balance sheets. They are compelled, forced by the ruthless logic of competition to consume as little of their profits as possible and to reinvest the vast majority of it to build even more capital. Why? Because if they don't, their competitor will. And that competitor will use that reinvested capital to build better machines, hire better engineers, and eventually drive the original capitalist out of business. In fact, an affluent corporate executive, a professional CEO, or a Wall Street investment banker is actually much more likely to spend lavishly on luxuries than the owners of the companies they work for. In fact, the sociologist Max Weber famously called this the Protestant ethic of the capitalist. All entrepreneurs have a single-minded focus on increasing the value of their company. And if you give them a choice between two things, one, making a healthy, stable, short-term profit from this quarter, or two, dramatically increasing the long-term valuation of their enterprise, even if it means taking a loss, they will always choose the latter. We see this every single day, by the way, around us in the world of startups. Companies are willing to take massive losses for years to acquire consumers and jack up their revenues because that is what determines how valuable they are, even if they are hopelessly, desperately loss-making. This is the first part of the puzzle. The goal is accumulation and valuation, not just profit. Now let's look at the second piece of the puzzle. Let's take this understanding back into the world of capitalist production, and let's look at how these two different groups, entrepreneurs and workers, spend their money, right? Professionals and workers, you and me, we use our salaries and wages to buy consumer goods and services. Food, clothes, personal care goods, gadgets, our Netflix subscription, our electricity and telephone bills, and so on. The more affluent among us also save money in banks or invest in mutual funds and stocks or invest in real estate or in gold and jewelry. This is our side of the economy. Entrepreneurs spend their money completely differently. Yes, they have personal expenses, but that is where they are acting as consumers, wearing the consumer's hat. Their business spending, the reinvestment, is on a totally different category of things. They buy capital goods, machines, raw materials, servers, factories, entire office buildings, software licenses, everything that is required to produce more goods and services. Now, both types of spending can be called consumption, right? But the capitalist spends on productive consumption, and their employees spend on unproductive consumption, on the pure and simple satisfaction of their wants and needs. This is not a moral judgment, by the way. It's a technical economic distinction that we have to make. One type of spending, the spending on capital goods, is used to expand the productive resources in an economy. The other type, the spending on a sandwich or a movie ticket, is simply used to help the worker get enough energy and rest to come back to work the next day. One type of consumption re-enters the production process as new capital. The other type exits the production process forever. This leads us to the most important concept in this entire video. If you understand this, you will understand the AI bubble. We can look at this from another side by breaking up the entire capitalist production system into two big segments. Follow this carefully. Segment 1, the capital goods sector. This segment produces capital goods, equipment, machinery, servers, data centers, microchips, and all the software that's needed to run them. Segment 2, the consumer goods sector. This segment produces consumer goods and services. Smartphones, cars, breakfast cereal, banking services, everything you and I buy and spend on. Now this is the critical part. Entrepreneurs in segment 2, the consumer goods guys, they produce for consumers like you and me. But who do the entrepreneurs in segment 1 produce for? They produce only for other entrepreneurs. An entrepreneur in segment 2, for example, a car company, needs to buy machines from an entrepreneur in segment 1, maybe a robotics company. And an entrepreneur in segment 1, the capital goods segment, such as the same robotics company I mentioned, also needs to buy machines like servers and chips from other entrepreneurs again in segment 1 to produce more machines. So segment 1, or the capitalist goods sector, produces for both itself and for segment 2. Segment 2 produces only for the public. Keep this two-segment model in your mind. Rewind and watch it again if you want to. It is the key to understanding what is happening in the world of AI right now. So now let's talk about bubbles. Capitalism is a chaotic, unplanned system, and it is marked by constant overproduction. Here's how it works. Capitalists get a signal from the market that a particular product is selling a lot and is very profitable. What do? They all rush to make more of it. And because there is no central coordination, they always end up making much more than what they can ultimately sell. The corollary of this is excessive investment. Money rushes out of sectors that have slow, boring growth, and it stampedes towards sectors that promise high, explosive growth. This is what causes bubbles to build up. Excessive investments pouring into specific sectors and companies, which then use the money to build massive capacity and produce far too much, way more than there is actual real demand for their products and services. Now note that bubbles can build up in both segment 1 and in segment 2. You can have a bubble in the capital goods sector and you can have a bubble in the consumer goods sector. But it is the bubble in segment 2, the consumer goods segment, which causes bubbles to burst. This is the secret. Let me explain this with an example. Imagine that the demand for smartphones goes up sharply one year, much more than there are smartphones available in the market that year. What's the first thing that will happen? The price of smartphones will go up. Why? Because those with more money will be willing to pay more to get hold of these scarce smartphones. This means higher, fatter profits for smartphone companies that year. The entrepreneurs at these smartphone companies see these profits and they want to make the most of it by increasing their production. That means building bigger factories. Now, it is obvious that 1 year's extra profits cannot pay for the heavy capital investments required to build massive new factories, right? So what do the smartphone makers do? They have to raise money now. They will either borrow from banks or they will sell some equity either to big venture capital funds or on the stock markets to the public, retail investors like you and me. And money will rush in. Why? Because the smartphone business now looks incredibly profitable and it looks like a very safe bet to investors. In fact, the boom is so big now that new entrepreneurs will start new smartphone companies to cash in on this gold rush. Now pay very close attention here because this part is crucial for us. When we try to understand the bubble in the AI business, note there are smartphone makers, segment 2 companies, consumer facing, have to buy equipment and machinery from our segment 1 companies to set up their factories before they can produce a single new smartphone. So the demand for equipment and machinery in segment 1 will also rise beyond its current capacity. Please note this, even though this rise in demand for capital goods in our segment 1 is ultimately dependent on the anticipation of increased smartphone sales in the future, this demand for machines and equipment comes before any increase in smartphone production. This creates a time lag, and during this time lag, the demand for capital goods is insulated. It's disconnected from the actual real world demand for smartphones. The companies in segment 1, the guys making the factory robots and the chip fabrication machines, they will successfully sell all their machinery, even if the anticipated smartphone sales do not ultimately materialize. They get paid, their revenues go up, their bubble inflates. But what happens if that consumer demand does fail at the end? What if for some reason there's a drop in middle class incomes or the government raises the GST on electronics and the demand for new smartphones suddenly collapses? For the smartphone manufacturers in segment 2, the consumer segment, the signal from the market is going to be immediate and brutal. Stores will see their stocks piling up and they won't order anymore. Smartphone manufacturers or companies will stop production, they will sack their employees and stop buying raw materials. Still, their inventories or stocks are cleared up. Their profits will of course collapse and so will their stock prices, and along with that, their valuation will collapse. In other words, any overproduction bubble in segment 2, which caters directly to consumers, tends to burst very, very quickly and it causes an immediate economic disruption. But the smartphone companies cannot stop building their new factories immediately, nor can they go back on the long-term equipment purchasing contracts that they had signed in the past. The collapse of consumer demand takes a much longer time to reach segment 1, where the capital goods are being produced. Why? This is also because of how these two types of spending are financed. We, the consumers, finance our consumption, our smartphones, our lattes, mostly from our income flow, from our monthly salary. If that salary gets cut, our spending stops immediately. Companies, on the other hand, build their factories and productive assets from their accumulated capital, from their massive war chests of cash, or from long-term debt they've taken. This pile of capital is not immediately affected by short-term slowdown in sales. In fact, there is a perfect parallel here from our own lives. Think about this. If someone were to lose their job today or were forced to take a pay cut, what's the first thing they would cut back on? They would probably stop eating out, stop holidays, not buy new clothes, stop their Netflix connection, but they will most probably continue to pay their home loan EMIs. They will keep paying even if they have to use up their savings. Why? Because they see these as building long-term assets for the future. This is true even when it comes to paying school fees for children, because even education is perceived to be a long-term asset for the future. Consumers cut back on consumption first. They try to protect their assets till the end. Capitalists do exactly the same, but on a much more massive scale. This is crucial to understanding why the current AI bubble is fundamentally different from every other bubble you've seen in your lifetime. Let's look at the last two big crashes. First, the dot-com bubble in the late 1990s. What was the bubble based on? It was based on the idea that consumers, you and I, would spend big on using internet services and that time this new thing called e-commerce. As it turned out, the idea was correct, except that it came a decade too early. The mega investments in dot-coms failed to pay off in terms of actual consumer demand. Consumers at that time just weren't ready. And the moment the market realized this, the valuations of dot-com companies collapsed completely. It was a segment 2 bubble dependent on us, the consumers, and it burst. Second, the subprime housing bubble of the mid-2000s. What was that? It was based on giving extremely cheap home loans to people who earned very little and sometimes didn't even have jobs. The assumption at that time was that the economic boom of the early 2000s would cause consumer incomes to rise very fast, and that would ensure that home buyers would be able to afford the high interest rates that were scheduled to kick in a few years after the home loans were initially given. But what actually happened? Incomes didn't rise. Consumers defaulted. The entire house of cards built on home loans collapsed completely. Again, it was another segment 2 consumer driven bubble. In both cases, low cost money flowed into sectors that were dependent on consumer spending and earning more, and in both cases that didn't materialize. This AI bubble is completely different. It is almost entirely restricted to segment 1, the capitalist goods sector, where the consumers are capitalists themselves, not you and me. Think about it. Where is all the money flowing? It's not flowing into AI powered to-do list apps for you and me. The money is flowing into the production of super powerful computer chips like Nvidia's H100s, massive electricity guzzling data centers for cloud services, and into the building and training of the large language models themselves. This is almost entirely capitalists selling to each other. Even the AI platforms are ultimately aiming for corporate consumers. No serious AI company actually expects consumers to pay full whack for their products. They give it to us for free or for a cheap subscription because we are not their ultimate customers. We are actually part of the product itself. We are training their models for free. The real aim is to sell to corporates who will use this technology to do just one thing: reduce their wage costs and increase their profit margins. This is why we see this strange investment and revenue loop, this Ponzi scheme of sorts that is going on inside the world of AI. And yes, watch my video on this if you want to know more. Right now, AI companies like OpenAI and Anthropic are buying billions of dollars in cloud services from companies like Amazon and Microsoft, who in turn are buying billions of dollars in chips from chip makers like Nvidia, who, along with Microsoft and Amazon, are also investing billions back into those same AI companies. It's a perfect closed circle. It is capitalists paying capitalists to buy products from capitalists who then reinvest in the original capitalists. The consumer, you and I, are not even in this equation. Yes, this is the question that everyone is asking. If human employees are going to be sacked en masse, who will buy the consumer goods and services that are produced in segment 2 or the consumer goods segment? That is when the overproduction in the capital goods sector will finally have to deal with the lack of demand in the consumer goods sector, right? Wouldn't that cause a general crash, an overall collapse of the entire economy? My answer is still no. And here are the reasons for that. Firstly, as I've just explained, the capital goods sector, in this case the entire AI economy actually, can continue to produce and expand for a very long time, even when the consumer goods sector collapses. Secondly, do we really believe that our governments will just sit by and let consumer demand collapse completely? We have seen governments repeatedly bail out big companies whenever they are in trouble. They will do the same for consumers if it means saving the system. So if there are no jobs, governments will simply provide a universal basic income to all so that people can continue to buy goods and services and provide profits to the capitalists who produce those goods and services, right? In fact, governments themselves are also going to be massive customers for AI companies, partly for national security and military reasons, and secondly to stay ahead of the geopolitical race. This is even more AI demand funded by taxpayers and by money printing. Finally, and this is the most important part of it all, the AI bubble isn't just about technology. It is about a crisis of capital. There is so much wealth now concentrated in the hands of a few thousand people in the world that they have no option but to continue to invest in AI. They can't just sit on cash forever. Inflation eats it. It's unproductive. Remember, the goal is accumulation. Unlike the last two bubble periods, the massive rise in stock market valuations in one segment hasn't translated into more jobs or higher pay, and therefore it hasn't created a consumer boom at all. Quite the opposite has been happening. Consumer-oriented companies have been doing pretty badly, even when tech stocks have exploded. For instance, take India. The largest FMCG company, Hindustan Unilever, has seen its revenue grow annually by a measly 2% rate over the past couple of years, much lower than even inflation. In the US, the S&P 500 index has been almost entirely driven by the Magnificent Seven or Mag 7 companies: Nvidia, Apple, Alphabet, Microsoft, Amazon, Meta, and Tesla. These companies now account for a staggering 35 to 38% of the entire S&P's value. The remaining stocks are barely moving. In terms of profitability, stock prices in the key consumer sectors like consumer staples, healthcare, utilities, and even financial services are all trading at roughly their historical average. There is no bubble there at all. So the rich, the capitalists, have already stopped betting on ordinary consumers and the things that you and I buy. They know that market is dead, yet they have to make their money grow. Look at these numbers. In 2007, right before the subprime bubble burst, the world's billionaires collectively had a net worth of $4.4 trillion. Right now, billionaires have a collective net worth of $16.1 trillion. That is a mountain of capital desperately searching for a return. A return it knows it cannot get from consumers like you and me because we just don't have the money to spend anymore. Right now, this money can only go into two places: AI and partly into gold. The first, AI. It's the only industry with a plausible potential for future growth. It is the ultimate segment one investment. And the other, gold. It's an unproductive asset, but it can help insulate the superrich against an overall collapse of capitalism itself. That is why I believe the AI bubble is not going to burst anytime soon. It can't burst. There is simply too much capital, too much money with nowhere else to go. Money will keep flowing into it, propping it up, expanding it far beyond what any rational analysis of consumer demand would suggest. I will be the first one to raise my hands and say I was wrong if there is a major stock market crash anytime soon, like the one that happened in 2008. But what do you think? Have I convinced you even a bit, or at least made you rethink the received wisdom on the AI bubble? Comment and let me know what you think. As always, join the debate so that we can all learn from our collective wisdom. And please do subscribe to my channel if you want more videos that challenge the official story. Until next time, de omnibus dubitandum, doubt everything.